Mike Bryan is a vice president and senior economist at the Federal Reserve Bank of Atlanta. I've known Mike for a long time. We worked together at the Federal Reserve Bank of Cleveland for many years. I can honestly say if I had to ask anyone to come here to give a talk about what the Fed is thinking about, what we can expect in terms of interest rate policy, the Fed's outlook, it's Mike Bryan. And I think you'll enjoy his talk. Anyway, Michael.
Peter. Wow, this is great. You know, there's a green room back there. No, seriously, you should come back later. I feel like bursting out into an Ethel Merman song or something. No, this is my big opportunity. I want to thank UCSB for inviting me here and for being a small part of their economic forecast project. As my remarks will make clear, I'm pretty critical of economic forecasters. But I think UCSB gets it right in the sense that knowing how bad economic forecasting is, or what Andrew said is economic forecasting is hard, which is another way of saying we don't seem to be doing it very well. Putting the information in the hands of people who need to know it with all its warts and doing it in real time and quickly, it's just invaluable. And most economic forecasters don't do that, and I think UCSB and their forecast project gets it exactly right. Look, before I give you an economic outlook, let me give the usual disclaimer. Anything I'm about to say doesn't necessarily represent the views of the Atlanta Fed or the Federal Reserve Board, but clearly I think it ought to. I don't know why they make me say this, but so I've been doing this a long time, and well, 37 years turns out, and yet I'm quite the skeptic when it comes to economic forecasting, as it's typically done. So how is it typically done? I go to a presentation and someone throws up a lot of slides, which I'm about to do, and they'll speak with great confidence about what the future is going to look like. But before I do that, I like to show this picture from this painting from De La Torre. It's called The Fortune Teller, where a man is being given a fortune and his dubious wife looks on as she should. And the great thing about the painting, of course, is that he's getting his pocket picked. And so if you go hear someone talk about what the future is, in particular what's going to happen in the next quarter's GDP or the next 4 quarters or the next 3 years, which is the frequency I typically think about, and they don't show you all the words, they don't show you all the assumptions, they don't show you all the insecurities in that forecast, then watch your pocket. Because you're missing something. You're not getting what you need out of an economic forecast. So here's something I want to point out. How good are economic forecasters? I mean, I actually do this all the time. I get all the economic forecasters. I track them. I see who's good. Not many. Who's bad? Quite a few. But this is the consensus. And it's just a 1-year ahead forecast for real GDP. So what I'm talking about here is if I asked forecasters in 1992, what do you think is going to happen to real GDP in 1993? So this is a December forecast for the next 4 quarters. They said 3%. And then the next year, so December of 93, what do you think is going to happen in 94, and so on and so forth. These are all forecasts that the consensus forecaster made in December of the year immediately before us. And so, okay, how did it turn out? Here's how it turned out. Completely missed this decade here, and never saw that recession coming. Sort of in the neighborhood over here, never saw that one coming. We were good there. These two weren't too bad of years. So what does that mean? So, well, here's one thing it means in a mathematical sense. The current consensus forecast for 2014 is about 2.7% with a standard error of 1.7. What? You thought it was smaller than that? And so that means that we're, 70% confident we're going to be somewhere between a booming economy and something that looks very much like we're heading into a recession. We're 70% confident that we're going to be in that range. So here's what I mean by warts and all. So, and Peter does a lot of this here at UCSB, and that is, so here's the consensus forecast for the economy going out through the end of 2015. And what I can do is I can build 70 and 90% confidence intervals around that. So you can see, within some degree of certainty how accurate that forecast historically has proven to be. And it's not. And maybe you think, oh, my favorite forecaster, I'm sure they get, no. That's not right. It's actually very hard to beat the consensus. And I can't beat them, not routinely. And I work hard at it, and a lot of people work hard at it. So this is just kind of another way of, again, saying what Andrew said was, forecasting is hard. And I'm going to make a request from you at the end of this that I think could help move us down to a little bit more accuracy. So here's something my boss asks me frequently. Why do I pay you? And my answer is, well, you certainly don't pay me just to give a forecast, but here's two reasons. And number one is our forecasts are better than a coin flip. And what do I mean by that? If you were just to predict what's going to happen next year is about what happened this year, we can beat that. Not by much, and not all forecasters can do that, but we can beat that. So it's better than guesswork. The second thing, and here's where I think it's most important, is that forecasts are really valuable as risk evaluation exercises. What is a risk evaluation exercise? So every time you get a forecast, you got to look at it and ask, what would the forecaster expect to see if that forecast is on path? And how quickly will you know when the forecast is starting to deviate and why? And in anticipation of that, the second thing is, every forecast is based on certain key assumptions. The forecaster knows what these are, and they ought to disclose it. And they ought to be able to show you relatively easily what would happen to their forecast if one of those assumptions proves incorrect. So whenever I give a forecast at the Federal Reserve Bank of Atlanta, one of the things the boss will always ask now is, what are the critical assumptions? Give me some alternative scenarios. It's all about risk evaluation. We know the forecast is going to, in time, be wrong, and sometimes horribly wrong. Where is it weakest? What will we be watching? And how quickly can we respond to the environment as it changes? So here's the FOMC's forecast. They had been telling us that the economy on average had been growing at about 2%, and now they tell us it's about to accelerate to a little bit more than a 3% growth rate over the next 2 to 3 years. FOMC ought to know what they're talking about, right? I wonder how accurate FOMC forecasts are. All right, let's see. So this is a little hard to read, but stay with me. I think it's worth the effort. So this is the date the FOMC made the forecast, okay? And this is the year they were trying to predict. So in January of 2009, when they were looking 2 years ahead into 2011, they were telling us, expect the economy to be growing about 4.25%. And they held to that 4% growth rate until the data started coming in by mid-2010, looking like things were starting to soften. And of course, then as the 2011 data came in, boom, the forecast came down, and what we saw was 2% was truth. Well, okay, but that was just, 2011 was a crazy year. How about 2012? Well, when we started looking at 2012, we were expecting the economy to show a growth rate of about 4%. And we held to that view until we got data that said that ain't going to happen, and boom, it turned out to be 2%. But you know what? 2012 was just a crazy year. See, the great thing is, a lot of Fed presidents are only around about 4 or 5 years, so I can usually get away with this for some time. So here's the 2013 forecast. It started out around 4%, and then it ended up around 2%, a little bit more. So now here we're into 2014. We're learning. Now we say 3.5%, and we've adjusted it to so it didn't work out very well for the FOMC. So what's my forecast? I must be better than this because I'm making fun of them. Well, so here's my forecast. We had a really bad first quarter. I don't know if you heard it out here in Santa Barbara, but the weather was really bad everywhere else in the United States. And we think it took maybe as much as 2 percentage points out of GDP. But that will be short-lived. Some of that production will be made up. In the current quarter, it already appears to be the case. And then we're expecting the economy to follow about a 3%, very close to a 3% trajectory over the next 2 to 3 years. That's my story. Why this eternal optimism? Why do we keep saying next year is the year? Well, I think Leo Hanian just touched on one of the reasons, although I don't know that he would agree with this particular variation on it. But here's the reason. By conventional measures, this blue line is where the economy is operating when it's essentially at full employment, when it's where it should be. It's at its potential. And when you have a recession, as we did here in early 2000, you tend to go a percentage point or two below potential, and then the economy will make up the lost ground. Well, here's the latest recession, and here's the slow growth economy we've been experiencing ever since. The gap between where we think we ought to be, our potential, and actual GDP, it's closing, but at a very, very, very slow rate. And so our economic models, and certainly our economic policymakers, who have an obligation, if they believe that this incarnation of potential GDP is accurate, to help close this gap in performance, to get the unemployed people working, to get production up to speed, have an obligation to try to close this gap. And it's still huge. And here are a couple of trajectories. If the economy continues on its current trajectory, we'll close the gap with potential GDP about the time the Cleveland Browns win the Super Bowl. So I'm projecting that to be, I'm from Cleveland, so I can do that, about the year 2036 or something like that. I'm not quite sure. But on a 3% trajectory, it'll take us about 3.5, 4 years to close the gap with potential GDP. And when the Federal Reserve says that we expect the economy over the medium term to ultimately regain full employment, this is what they're talking about. And then if we continue to follow this trajectory, the question becomes a policy question. Are we doing all we can as policymakers? All right. I think there's more to the 3% growth rate scenario than just wishful thinking and some notion of under-economic performance. We think something's been holding the economy back. Headwinds is what Bernanke used to call it. What were those? The financial shock to household balance sheets. That seems to be not fully repaired, but well on its way to being repaired. Households' balance sheets are in a much stronger position, and the idea is that as they get back to a more normal, I'll tell you how we define that later, a balance sheet position, they'll go back to their old spending ways. Likewise, household debt service, really low. Households would seem to have the ability to take on more debt if banks would lend it to them. And there's nothing on the liability side that would seem to be, especially with interest rates at essentially zero, that would be holding consumers back. There are other things that we think have been holding households back, the economy back. One is real estate. A real estate collapse got us into this mess. It wreaked havoc on our balance sheets, both in the financial sector and in personal balance sheets. Homeowner equity is improving with housing prices. This is important to our outlook. Finally, business uncertainty. We talk to a lot of businesses, and they tell us the same thing. That is that over the last 3 or 4 years, there's been so much uncertainty about economic policy, the state of the economy, the global economic situation, that they weren't ready to invest. They were not putting money down on the table and making major commitments until they had more clarity. They're telling us now that clarity seems to be returning. Households are telling us the exact same thing. So this is the willingness of a household to buy a major durable purchase. And again, we're right back to what we would consider roughly normal times. So this is, and there are others, these are some of the economic fundamentals that would say, this time it looks different. This time it looks like there's certainly the capacity for the economy to kick it up a notch to a new higher growth rate. All right, so that's my forecast. I think the current quarter is going to be gangbusters, and after that we're going to settle into a pretty decent 3% plus growth rate. But I've already demonstrated I don't know how to forecast. I'm as good as any, though. So what about this risk perspective, a risk assessment I was talking about? So what are the things that I'm going to tell the boss we're looking at to validate whether or not 3% is the right forecast? And what are the key assumptions? If something's going to go wrong, where are some of the areas that we think, it could go most wrong? So here is an experiment that we do in Atlanta. So here's our forecast. I'm technically not allowed to show you our forecast. I have to say it's my personal forecast that I then give to the boss who makes it our official forecast. And this is what I just showed you. Our current tracking estimate, by the way, on the basis of the incoming number is that the economy is really popping up around 4%. Might even raise that up to 4.25% here pretty soon. Here's the alternative projection. This is the same old, same old. I mean, we've been saying this for quite some time, but we've been getting this. So if I run simulations with this 2% same old versus the 3% this time it's really arrived, what do my models say is going to be most different? Where will it become most obvious in the economic models that we look at? Here's one, industrial production. Our models say that if this 3% growth rate scenario is the right one, we should expect to see industrial production grow at roughly twice its current growth rate. And we ought to start seeing it over the next couple of quarters well in excess of 4%. That historically would be one of the first indicators that we would look at. We haven't gotten any of the incoming data yet to verify this, but we've got some survey data up here that says between February and March there was a pretty significant upturn in attitudes in the manufacturing sector, and I'd be interested in your opinions on this. Here's another one. This is consumer spending under the 3% scenario versus the same old, same old. We expect a big pop in consumer spending, and what we've seen lately, this is our current tracking estimate, is up over about 4.25%. Consumer spending is really coming in gangbusters. Maybe this is just the warmer weather and there's a little bit of exuberance going on here, and it's only 1 month or month and a half worth of data, so I wouldn't put a whole lot of confidence in this number. But the point is, these are some of the things that we're looking at. And here's a third that our model pops out of our models and says, if the 3% growth rate scenario is right, one of the things that you're going to look at is non-farm employment growth, holding up very close to 200, maybe a little more than 200,000 net new jobs a month. If it doesn't, our models say expect employment to drop off to under 150,000 net new jobs per month over the next 6 months or so. So we're going to look at all the data, of course, but here are the 3 big indicators that our models say, if this time really is different, watch these things because they'll validate it for you. All right, I make a forecast. It's based on a lot of assumptions. Which ones make me least comfortable? housing. What if the housing market softens? And some of the incoming numbers have not been all that kind with respect to housing prices, housing starts, new home sales. Second thing I think we ought to take a look at is a lot of our forecast is based on confidence. And confidence seems to be improving. But confidence is a fleeting thing. What if it doesn't? And then third, what if somebody shuts off the oil? We actually do about 8 or 9 of these simulations before we go to an FOMC meeting. But these are the 3 that I just want to show you to give you a taste of risk assessment and economic forecasting. So here's housing prices. They've been leveling off recently. We've gotten some incoming numbers that look a little soft. What if this happens? What if housing prices stop rising and instead of double-digit year-over-year growth, they just stagnate to 0? And with that, housing starts and housing sales just kind of level off. They're not declining, but they're just not getting any better. We put this into our models, and our baseline scenario becomes this green dotted line, which is take about, I can't remember what it said, 3/4 of a percentage point out of GDP growth over the next year and a half. If the housing market deteriorates more quickly than that, it's not what we're projecting, but if it does, then things start to accelerate. But again, this would seem to be one scenario that bears careful watching, making sure that the housing market maintains some momentum. Here's a perennial scare story, oil shortage. I'm thinking of taking this one off the watch list right now because, boy, there sure seems to be a lot of oil out there right now. But whenever you have a geopolitical tension, whenever something bad happens in the Ukraine, and that seems to be almost every day, or elsewhere around the world, it oftentimes is felt in oil prices, and oil prices make a lot of good forecasts go bad. So what kind of scenario am I thinking about here? Oh, hell, I don't know. But let's just say oil prices go up by about 35% over the next 6 months, and they hold at that level for about a year. What happens to the economy? Well, very quickly things deteriorate and we go into a small recession. Again, I'm thinking of taking this off the watch list because I simply don't think at this point this is a very realistic concern. And finally, here's the no confidence scenario. What if the public isn't as optimistic about the outlook as I am? What if you, business people, households, say, you know what, I'm still going to play it very conservative. I don't like the incoming numbers. I don't like employment prospects. I don't like the potential tax implications that I'm seeing. Under those conditions, the economy slips very quickly back into the 2% growth scenario. And again, it's same old, same old. This is the economy we think we've been seeing for 3 or 4 years now, and it continues. So let me, I got to do a few things. Number one, the unemployment rate is falling pretty quickly, a lot faster than we would have guessed given the strength in the economy. Some of the early comments touched on this, that it certainly looks in the data as though a large number of unemployed people aren't going into employment. They're disappearing off the labor force for some reason, and we're not entirely sure where they're going. Some are going to school. Some are going into a category. In fact, most are going into a category that the government calls other. We're having trouble figuring out what people do in that other category. But the unemployment rate is falling pretty quickly. And it could very well happen that we get to what most people in the FOMC consider the natural rate, the potential rate of full employment in the economy very, very quickly, maybe even faster than our current economic forecast. Does that mean that all is good with the world, that we've arrived at where we think the economy ought to be? My answer to that is no, I don't think so at all. In fact, here, this chart shows you 2 variations of unemployment. This blue line is standard unemployment. And I want to add into that something we'll call the shadow labor pool, which are people who are either marginally attached to the labor force for one reason or another, discouraged, or a big share of this are people who are working part-time but really want to work full-time. And because of that rather large gap in shadow labor pool, we think these workers are exerting a lot of downward pressure on prices. And they're doing it through wage growth. So going into this was also something that somebody talked about earlier. I think it was Leo Hanian, who said that wage growth had slowed down, and pre-crisis wage growth was around 3.5%, but over the recovery it's been down around 2%. Why? Our estimates show these bars here. This is the influence that shadow labor pool is having, we think, on wage growth. As long as that goes on, we're having trouble getting the rate of inflation to move up towards our 2% objective. Even though the unemployment rate is quite low, we think there is enough labor market dysfunction, and here I'm going to say the royal we, the Federal Reserve Bank of Atlanta at least, think there's enough labor market dysfunction. There's a big enough shadow labor pool to hold the rate of inflation down. And if we get the 3% growth scenario, it's going to take us several more years to get back up to our inflation target. And if we don't get that kick up in economic growth, then it's very difficult for us to figure out how we're going to get the rate of inflation up to target. I never thought I'd live in a world where the central bank would quintuple the size of its balance sheet and the rate of inflation would go down. I just never thought I'd be there. All right, so that's my national outlook. I think the economy is going to go 3%, and this time I really mean it. But just in case, I think the key indicators to watch for is the behavior of manufacturing activity, consumer spending, and we got to keep at least 200,000 net new jobs growth. Here are some key scenarios that I'm watching. I would say that B is a pretty big one, that the housing market deteriorates, or a C if your confidence goes nowhere. I can spend a moment or two talking about monetary policy. There's not a whole lot to say. Interest rates hit zero. That's usually how we conduct monetary policy, but I don't know, we have mathematicians that are telling us it's hard to actually get the rate to go negative. So what are we doing in the absence of a negative interest rate? Well, one thing we do is QE. We expand the size of our balance sheet. What is QE? Yeah, it's sort of like that. And the way you see it, here's when we were lending to banks and other financial institutions, all that's disappeared. Really pay attention to the two blue areas. These are mortgages here. These are U.S. Treasury securities. Here's QE1. We bought a whole lot of mortgages to support housing. Here's QE2. We bought a lot of mortgages and a lot of government securities to fight deflation. And now we're winding down QE3 in support of the labor market. We started buying $85 billion worth of assets a month. We've whittled that down to $45 billion. We expect it to be around zero before the end of the year. The other policy tool is we're trying to tell the world that interest rates will remain low for a very long period of time. So here's where the long-run average federal funds rate is. The FOMC has said, you get to the end of this year, we're still going to be at zero. By the time you get to the end of next year, interest rates are likely to have lifted off from zero, but very slowly, and it could take many years for interest rates to renormalize and get back to something you and I would think is more typical of an economy. Let me close with one more thing. I work hard at economic forecasting, and like I said, I'm not very good at it, and I blame you. And the reason I blame you is, well, you are the economy. So what I'm trying to do is predict your behavior. And so it must be your fault. And so one of the things that we are doing, we are partnering with Stanford and we're partnering with the University of Chicago to do what we're calling a decision makers poll. And what we want to know is, what do you think is going to happen in your business over the next quarter, over the next year, over the medium term? And how certain are you in that conviction? So we not only want to know what you think is going to happen, your forecast, and see how it differs by region and by industry and by firm age and size, but also how certain you hold these convictions. We've begun doing this with about 310 businesses, and we're getting all sorts of interesting information. I won't go through it, but what I would like to do is appeal to your good nature and volunteer to be one of our panelists. If you want to take our forecasting poll, it's a monthly poll. It takes 4 minutes. It's all automated. All you have to do is email yes to this email address, and we'll get you all dialed in, and maybe I'll come back next year, and I'll tell you what you said the economy was going to do in 2015. Thank you.